Right now you're looking at your bank account and you see $10,000, maybe $50,000 sitting there, looking safe and secure. You probably feel a sense of responsibility, maybe even a bit of pride, because you've done exactly what society and your family always told you to do. But the uncomfortable truth nobody wants to talk about is this: you're actually the victim of a mathematical crime. Because that money isn't just sitting there protecting you, it's evaporating right in front of your eyes. An invisible tax is constantly chipping pennies off the value of every dollar you own. You might think you've built a safety net for your future, but you're actually building a trap that makes you poorer every single day you leave that money sitting still. By the end of this talk, I'll show you why your emergency fund might actually be your biggest financial burden, and we'll break down piece by piece the banking system that feeds on your fear, so you can finally stop losing purchasing power. To understand why this happens, we need to look at the math banks never want you to figure out on your own, because their entire business model depends on your ignorance. The average savings account in America, while the cost of living relentlessly rises every year, often pays a pitiful interest rate of around 1.5%. When you actually run the numbers, if the bank pays you less than 0.5% while inflation eats away 3% or more, you're not saving money at all. In effect, you're paying an annual fee of 2.6% for the privilege of letting your cash rot there, while the bank enriches itself using your capital. If you have $50,000 in a standard bank account today, that money will likely have the purchasing power of only $37,000 in 10 years, meaning you'll have lost $13,000 without spending a single cent. I call this the silent heist, because the bank takes your money and lends it to others as car loans and mortgages at much higher rates. Most smart and hard-working people fall into this trap not because they don't understand math, but because their biological programming works against them in the modern financial environment. We've talked before about the poverty brain concept. Growing up amid financial instability programs your mind to see every expense as a threat and every dollar in the bank as a survival tool. When you see a large pile of cash in your savings account, it acts like a sedative for your amygdala, telling your primitive brain you have enough resources to survive the winter. This false sense of security triggers a concept in behavioral finance called loss aversion. The pain of losing money is psychologically twice as intense as the pleasure of gaining it. You're terrified of seeing red numbers on an investment screen, so you choose the guaranteed loss of inflation over the market's potential gain, because in the moment it feels safer. To truly break free from this mindset, you need to understand that banks aren't storage lockers where specific dollar bills sit in a vault waiting for you to come back. Banks operate on a system called fractional reserve banking. They hold only a small portion of your deposit and lend out the vast majority to others. Your deposit becomes someone else's car loan or small business loan, earning the bank 7% or even 25% on credit cards, while they pay you almost nothing for it. When you hoard cash in a low-interest account, you're essentially acting as the bank's unpaid employee, supplying raw material for their profit factory while you pay the inflation tax. Wealthy people understand this game and refuse to let their capital sit idle, because they know money needs to be in motion to grow, and stagnant money is dying money. We can put an actual price tag on this over a long period by looking at the concept of opportunity cost, which reveals the real damage of playing it safe. Say you're overly cautious and decide to keep $50,000 in your savings account just in case, even though you probably only need $10,000 for true emergencies. If you took that extra $40,000 and invested it in a boring, low-cost index fund averaging 10% returns, it would grow to roughly $697,000 over 30 years. This doesn't mean the decision to keep that money in the bank for emotional comfort cost you nothing. It actually cost you over $650,000 in lost future wealth. You're effectively paying the bank hundreds of thousands of dollars over your lifetime to babysit money you didn't even need to touch, the most expensive insurance policy you could possibly buy. One of the biggest reasons people fall into this expensive trap is having a terrible definition of what actually counts as a financial emergency. Most people treat their savings account like a slush fund. When they see the balance is high, they think they can afford a vacation or a new couch. We need to redraw the lines, because a roof replacement 5 years from now isn't an emergency, it's a planned capital expenditure you should be saving for separately in a different bucket. Your emergency fund isn't a fund for lifestyle upgrades, it's financial insurance designed to keep you from selling your assets at the wrong time. Liquidity is oxygen, because when the market crashes and you lose your job at the same time, someone with no cash has to sell their stocks at the bottom to pay rent, which permanently destroys their wealth. The solution to this isn't draining your bank account to zero, but implementing a specific algorithm I call the liquidity ladder to determine exactly how much cash is too much. The first rung of this ladder is your sleep-well buffer, sitting in your checking account and covering 1 month of expenses plus a little extra, so you never overdraft. This money is just the grease that keeps your life's engine running. You don't care about its return, only its utility. The second rung is your actual emergency fund, which should live in a high-yield savings account earning 4% or 5% instead of sitting in a traditional bank earning nothing. If you're single and renting, you need 3 months of essential expenses, but if you have a family or a mortgage, aim for 6 months. Once that bucket is full, you must force yourself to stop filling it and redirect every additional dollar to the third rung, your wealth engine. This is where the magic happens, because every dollar that comes in after your emergency fund is full gets deployed into tax-advantaged retirement accounts or taxable brokerage accounts. This money buys assets like index funds and real estate that let you own a piece of the global economy and actually fight inflation. If you're sitting on a large pile of cash right now and feel terrified to dump it all into the market at once, you can use a strategy called dollar cost averaging to ease that fear. You can divide your excess cash into 6 chunks and set up an automatic transfer to move one chunk into the market on the first of each month for the next 6 months. This approach works because it removes emotion from the decision and turns market volatility into a psychological advantage instead of a source of stress. If the market drops after your first contribution, you actually cheer, because next month your automatic transfer will buy more shares at a discount, lowering your average cost basis. If you're young, you need to understand that your biggest risk isn't the stock market temporarily going down. The real risk is running out of money in old age because you played it too safe. The stock market has historically returned about 10% annually while inflation runs around 3%, giving you a real 7% return that builds wealth. Cash earns almost nothing, meaning the difference between holding cash and holding assets is the difference between a comfortable retirement and working until you die. Executing this strategy requires shifting your identity from a saver to a capital allocator who treats every dollar like an employee. If an employee is sleeping on the job in your checking account, you need to fire them and move them to a department where they actually have to work, your investment portfolio. You should calculate your monthly burn rate by looking at your last few months of spending and multiply it by 6 to define your absolute cash cap. Any money above that specific number is lazy money that needs to be deployed into assets immediately, or it's simply losing value. You need to automate this entire process so that once your checking account hits a certain level, everything else sweeps into investments without you having to make a decision. The uncomfortable truth is that comfort is expensive, and keeping all your money in the bank is a tax you pay to your own anxiety. You need to get comfortable being uncomfortable, used to seeing your net worth fluctuate, because that's the price of admission for building real wealth. The safety trap lures you in with the promise of security, but delivers poverty by letting inflation eat away the value of your labor from the inside. Real financial freedom doesn't come from a stagnant pile of cash, it comes from assets that work harder than you do. So you need to cap your cash and invest the rest. Your future self is counting on the decision you make right now, so don't let them down by choosing the easy path today that leads to a hard life tomorrow. Let's go deeper into why this mindset shift is so hard for so many people raised believing cash is king. Looking at the wealthiest people in the world, you'll notice they hold very little of their net worth in actual cash, because they understand the concept of the velocity of money. Wealthy people treat money like a hot potato that needs to move into an asset as quickly as possible before it cools and loses value. They understand cash as a depreciating asset. That sounds contradictory, but it's an absolute truth in our modern economic system. Every day you hold $1, it buys slightly less than it did the day before, meaning you're on a treadmill constantly moving backward. Even if you just stand still, you're actually moving backward. That's why the middle class feels like they're running faster and faster just to stay in the same place. The banking industry spends billions on marketing to convince you that savings accounts are the smartest place to park your wealth, because they need your deposits to fund their lending operations. They offer you free toasters or small cash bonuses to open accounts because they know the lifetime value of your deposits is worth thousands of times more than that sign-up bonus. They're pitting your fear against their knowledge of how the financial system actually works, and they win every single time you leave excess cash in their accounts. You need to stop being a customer of the bank and start thinking like the owner of the bank, becoming an investor who lends capital to the economy. When you buy a stock or an index fund, you're essentially becoming an owner of the companies that drive the economy, rather than just a consumer who buys their products. This shift from consumer to owner is the fundamental difference between those who build generational wealth and those who struggle to make ends meet despite earning a good income. It's not about how much you make, it's about how much of what you make is working for you instead of just sitting there waiting to be spent. Many people carry a scarcity mindset, telling them they might need that money someday for some undefined future disaster. While it's true disasters happen, the vast majority of financial emergencies can be covered by that 3 to 6 month buffer discussed earlier. Keeping $50,000 or $100,000 in cash for a disaster that might cost $5,000 is an incredibly inefficient use of resources. It's like wearing a full suit of armor every day in case someone throws a pebble at you. We also need to address the psychological comfort of seeing a big number in your bank account versus that same number in an investment account. When the market is volatile and your investment account balance drops 10% or 20%, it can feel like you're losing real money, which triggers that panic response we discussed. But you have to realize that the stability of your bank balance is an illusion, because while the number stays the same, what that number can buy is shrinking. In an investment account, the number might fluctuate wildly short-term, but purchasing power grows over the long term. You need to train your brain to look past the volatility and focus on the long-term trend, which has always been upward for the U.S. stock market. You also need to consider how taxes affect your savings strategy, another area where the wealthy have a massive advantage over the average saver. Interest income from savings accounts is taxed at your ordinary income tax rate, the highest rate you pay. Capital gains on investments held for more than a year are taxed at a much lower rate. This means you keep more of what you earn. By keeping your money in savings, you're subjecting yourself to the highest possible taxes on the lowest possible returns, a recipe for financial stagnation. Moving your money into investments not only increases your potential returns but also improves your tax efficiency, accelerating your wealth building even further. Another critical aspect of escaping the safety trap is understanding the difference between saving for a specific goal and hoarding money out of fear. If you're saving for a down payment on a house you plan to buy in 2 years, keeping that money in cash or a high-yield savings account makes sense, because you need the principal to be safe. But if you're hoarding money with no specific timeline or purpose, just because it feels good to have it there, you've fallen into the trap. You need to give every dollar a job and a timeline so you know exactly where it belongs. Money you'll need in the next 12 months belongs in cash. But money you won't touch for 10 years belongs in the market. It's also worth recognizing that inflation isn't just about the price of milk and bread rising, it's about the cost of your future freedom increasing. If you plan to retire in 20 or 30 years, the amount of money you'll need to support your lifestyle will be significantly higher than today. $1 million might sound like a lot right now, but in 30 years it might only have the purchasing power of $400,000 today. If you keep your wealth in cash, you're guaranteeing you'll fall short of your retirement goals, because you're racing against inflation with a strategy designed to lose. Investing is the only reliable way to outpace inflation and ensure your money holds its value over decades. The liquidity ladder concept gives you a structured way to balance your need for safety with your need for growth, so you don't have to choose one over the other. You can have the peace of mind that comes from a cash buffer while still participating in the global economy's wealth creation engine. This lets you sleep at night knowing you can handle an emergency, while also knowing your future is being secured by your investments. This balance is the key to sustainable wealth building, because it addresses both your psychological needs and your mathematical reality. You also need to be wary of advice from friends and family who mean well but are trapped in the same poverty mindset. They might tell you the stock market is gambling, or that cash is the only safe place for your money, because that's what they were taught. But look at the results of that thinking and ask yourself if you want to end up in their financial position. If you want different results, you have to do something different. That means breaking from the herd and making decisions based on data rather than fear. The transition from saver to investor is a journey requiring education and discipline, but it's the most rewarding journey you can take for your financial health. You start by building that foundation of safety with your emergency fund, then systematically build your wealth on top of it. You don't have to be a genius to do this. You just have to be consistent and willing to tolerate a bit of short-term volatility for long-term gain. The market will go up and the market will go down, but over the long run it has always rewarded those who stay the course. Think about the legacy you want to leave for your family and the example you want to set for your children about money. Do you want to teach them to live in fear and hoard their resources, or do you want to teach them to be smart allocators of capital who understand how to make money work for them? Breaking the cycle of the safety trap isn't just about your bank account. It's about changing the financial trajectory of your entire family tree. When you master these concepts, you give yourself the freedom to live life on your own terms rather than being a slave to a paycheck or a victim of inflation. So take a hard look at your finances today and ask yourself whether you're really saving or just slowly losing money. Calculate your real burn rate. Define your emergency fund cap and start moving that lazy money into productive assets. Seeing your cash balance drop as you move it into investments might feel scary at first. But that fear is just your primitive brain trying to keep you safe in a world that no longer exists. Trust the math, trust the market's history, and trust yourself to handle whatever comes your way. You have the tools and knowledge to break free from the safety trap and build the wealth you deserve. Remember, every day you wait is another day inflation chips away at your hard-earned money. The best time to start this process was yesterday, but the second best time is right now. Don't let analysis paralysis keep you from taking action, because the cost of inaction is far higher than the risk of investing. You're capable of managing your wealth and securing your future. But you have to take the first step. Move that money, automate your investments, and stop paying the fear tax that's keeping you from your potential.